We'll
This
discuss
conference will now be recorded.
just a minute, it's disturbing. So today we'll discuss a few requirements under the various laws and the implications where we require valuations and what kind of valuers can undertake those valuations. These will be the key contents for the discussion today. We'll first see what key statutes are generally requiring valuations, and then we'll just break down on the various sections and the provisions where valuations are required to be undertaken. So yeah, in the past so many years, for which I think we all have been practicing valuations, I've witnessed that this profession it's evolving with a lot of requirements which are undergoing major changes. One such major change which we saw a couple of years ago was the concept of registered valuer. So in my understanding, yes, regulators are trying to formalize, they are trying to organize the profession, which can bring about more transparency and better governance. So today's session is directed at explaining the various legislative requirements of valuation of securities and financial assets in India under Companies Act, Foreign Exchange Management Act, the Income Tax Act, Sebi regulations, and Insolvency and Bankruptcy Code 2016. One single transaction can actually require more than one regulatory compliances, and so the purpose of this session is to walk everyone through the major instances when valuation is required under the various legislations and the professionals who are eligible or who are required to undertake or who are qualified to undertake the respective valuations. And I would like to, before starting the session, I would like you all to note that this is not a comprehensive or an exhaustive list, and there could be more valuation requirements and other statutes which require valuations other than the ones we will be discussing today. But yes, what I have tried to highlight or bring across is some other statutes which are commonly used and which will be used in regular parlance. So some of the valuation professionals who can undertake valuations are, of course, registered valuers under Section 247 of Companies Act, a chartered accountant in practice, a practicing cost accountant, a merchant banker registered with Sebi, and investment banker or CPA for foreign companies. Let us discuss the valuation requirements under Companies Act 2013. The Ministry of Corporate Affairs had issued the Companies Registered Valuers and Valuation Rules 2017 in October 17. And securities or financial assets is one of the asset classes which are required to be valued by a registered valuer under the Companies Act 2013. The various sections under which a registered valuer is required to undertake valuations under the Companies Act 2013 are explained in the coming slides. But just to give you a summary, these are some of the important sections under which we are required to, undertake valuations. Let us just discuss them in the coming slides. So section 247, subsection 1, that's the guiding section. It's for valuation by registered valuers. Now, yeah, this is the master or the guiding section for valuation, and it implicates that when there is a requirement of valuation of any asset or liability or net worth of a company under any provisions of the Companies Act 2013, then such valuation will be required to be undertaken by a registered valuer. And such a valuer has to be appointed by the audit committee or in its absence by the board of directors of that company. So this is the guiding section, section 247. In cases where you have to, or where the company issues sweat equity shares, section 54 comes into play. So section 54 contains provisions relating to issue of sweat equity, which are required to be issued at a value determined by a registered valuer, along with justification for such a valuation. Also, valuation of intellectual property rights or know-how, they are also required to be undertaken by a registered valuer. So essentially, two valuations could be required: valuation of equity shares and valuation of IPR. Now, in cases where where the sweat equity shares are getting issued for non-cash consideration, then the value of the consideration will also be determined by a registered valuer. So there are a couple of instances within this section where a registered valuer will be required to undertake the valuation. That will be of the shares itself, of the IPR, and for shares issued at for a non-cash consideration. What does section 62 require? What I think that is one of the predominant sections for which we all undertake valuations. Give me 1 minute. I can't see any comments or chats actually. Okay. So one of the common valuation requirement, which is section 62 1C for further issue of share capital. Now, whenever a company proposes to increase its subscribed capital by further issuance of shares, through preferential allotment, then the value of such shares will be determined by a registered valuer. Section 62 valuation report is mandatory for preferential allotment of shares and also for issuing convertible or partly convertible securities like compulsorily convertible preference shares, optionally convertible preference shares, CCDs and OCDs, and similar hybrid instruments. The rule 13 of the share capital and debenture rules, it defines shares or securities as equity to include equity shares, fully convertible debentures, partly convertible debentures, or any other securities which would be convertible into or exchanged with equity shares at a later date. And the price of shares or other securities which have to be issued on a preferential basis, it cannot be less than the price which has been determined based on the valuation report of the registered valuer. So the recommendation that the registered valuer is making is the minimum price for the purpose of that transaction. Now, it should also be noted that the price of the shares to be issued on a preferential basis by a listed company, it will not be required to be determined by the valuation report of a registered valuer under this section, and it will be made in accordance with Sebi regulations. Oh, okay. All right, nothing more on this slide. Valuation by a registered valuer will also be required under section 192 on restrictions on non-cash transactions involving directors. So section 192, it allows a company to enter into an arrangement under which the company acquires assets for consideration other than cash from a director or a person so connected with him. So say a tangible asset is acquired by the company from a director for allotting shares as consideration, or a director of a company or a person connected with him, he acquires assets for consideration other than cash from the company. Now, if the company is issuing shares to its directors for acquiring the asset, then section 62 also gets triggered for preferential allotment of shares here. So here there will be a requirement of compliances with two sections. So, and for any of these transactions, the value of assets which are involved in this arrangement, they are also required to be determined by a registered valuer. And the registered valuer can be of any relevant category, that is land building, plant machinery, or securities or financial assets. Section 230, again, something which we all commonly use, that this is for compromise or arrangements with creditors and members. In case of a dispute or an anticipated dispute between a member or a creditor and the company, and an application for compromise or arrangement can be made to the tribunal by the company or any creditor, any member. And if the company is being wound up, then the liquidator can also make this application. This application has to be accompanied with a valuation report, which contains the valuation of shares, property, and all assets of the company by a registered valuer. The tribunal may pass orders for the compromise or arrangement with the creditors and members, and pursuant to which there can be a meeting. But yes, the notice of that meeting to be held is required to include a copy of the valuation report, and this report also has to be issued by a registered valuer. So, if you see point 5, a valuation report in respect of the shares and the property and all assets, tangible and intangible, movable and immovable of the company by a registered valuer are required. Then we have scheme of corporate debt restructuring, section 230. Here again, you will require a valuation of a copy of the valuation report. Valuation by a registered valuer is also very frequently required under section 230 for mergers and amalgamation of companies. So the fair price of shares, which is to be determined by a registered valuer after taking into account the valuation parameters, which includes the return of net worth, book value of shares, earning per share, price to earnings multiple vis-a-vis the industry average, and the other parameters which are customary for valuation. So valuation of both companies are required to be undertaken, and a share exchange ratio is also required to be computed for this particular section. Now, in situations where the transferor company is a listed company and transferor company is an unlisted company, the transferee company continues to remain an unlisted company till the time it actually gets listed. And in this period, if the shareholders of the transferor company, they want to opt out of the transferee company, then the value for this arrangement is required to be undertaken by a registered valuer. Now, if there's a company which is registered outside India and it is merging with a company in India, or even the other way around, then also there is a valuation requirement. In cases where there is no change in shareholding pattern in case of a demerger, or in case of a merger with a WOS or a wholly owned subsidiary or a company, then again the valuation reports, they are not mandatory, but it can still be obtained by a registered valuer. Okay. Purchase of minority shareholding under section 236. So there at times there could be cases where an acquirer is already holding 90% or more of the issued share capital of a company, and he is desirous of buying the remaining equity shares or the minority holding as well. Now, such acquirer, he is required to notify the company, and he can make an offer to the minority shareholders for acquiring the remaining equity shares at a price determined by a registered valuer under section 236 for purchase of minority shareholding. An RV report will also be required to be submitted to the tribunal in cases where the tribunal has made a winding up order, or it has appointed a liquidator or a company liquidator. NCLT will appoint a liquidator who will have to submit various reports, including the valuation report. And the valuation report has to be prepared by a registered valuer. And it generally has to contain the nature and details of assets, the location of assets and their value under section 281 for submission of report by a company liquidator. But yes, now we also have IBC. So similar valuation is required under regulations and provisions of IBC 2016 as well. Valuation report by audit committee. So and this is guided by section 177 of Companies Act. So every audit committee is required to act in line with the terms specified in writing by the board, which will also include valuation of undertaking or assets of the company wherever it is necessary. And the valuation so required is to be undertaken by a registered valuer. Okay. And there are also references of transaction on a slump sale basis for this particular guiding section. Then we have section 305, which is valuation for voluntary winding up. So under section 305, on declaration of solvency in case of proposal to wind up voluntarily, a valuation report of assets of the company is required to be prepared by a registered valuer. Okay, so where there are any assets of the company, it has to be accompanied by a report of the valuation of the assets of the company prepared by a registered valuer. Yeah, we will discuss this, and that is covered in the coming slides. Yeah, so it's coming here instead. So some valuation requirements. So we also have requirements for valuation under accounting standards, which are mandated by Companies Act. So some of them could be share-based payment or business combinations, fair valuation of unlisted investments, fair valuation of investment properties, leases, employee benefits, for impairment testing. So personally, I mean, I have come across or seen two interpretations as well as valuations for accounting standards are concerned. So the first interpretation is that the valuation should be undertaken by a registered valuer because the accounting standards are mandated by Companies Act 2013. And that is why, it's very obvious that a registered valuer should undertake it. However, I've also seen practically happening that as long as valuation is done by any expert, that is also acceptable from an accounting perspective. But of late, I think most of us will be signing as RVs for any compliances relating to Companies Act or under various Indian accounting standards. So if you have views, we can discuss them at the end of the session and obtain more clarity on this. Then there are certain transactions where valuation is not specifically mandated, but companies still do obtain valuation reports as part of good governance practices. So one of them is buyback. So there have been cases, so though it's not mandatory, there have been cases where the ROC has probably returned the form submitted for resubmission stating that the valuation report is not enclosed. So again, I have seen clients in some cases obtaining and then not obtaining also for buyback. Then there's reduction, the capital reduction. Again, no specific provision for valuation is mentioned anywhere in that guiding section. But because of good governance requirements, because capital is being repaid because with the cancellation of certain shares in the process, companies or corporates may obtain a valuation report. Sebi, there's a Sebi circular also. It requires valuation report from a registered valuer to be furnished along with the fairness opinion from a merchant banker where there is any change on shareholding pattern consequent to a scheme or arrangement or reduction. And then there are consolidation of shares and consequential payment for fractional holdings. So again, there is no mandatory prescription for valuation in such a case. But it may be appropriately considered again from good governance perspective on a specific case basis. So then there are various rules also under Companies Act 2013. So we'll just go through them. Valuation report of assets of a Section 8 company is required to be filed with its application to convert itself into any other kind of company. Then security value of assets for creation of security for uninsured deposit, that also needs to be determined by a registered valuer. If there are bonds and debentures and they are issued and secured by assets, then the value of such bonds and debentures shall not be of a value higher than the value of the assets determined by a registered valuer under the rules for taking deposits. Now, if there's a company, it's lending money to its employees or trust for acquiring its own shares, then such share purchase in case of listed entities, that should unlisted entities, it should be as determined by a registered valuer. And a valuation report is also required to be filed when return of allotment is filed involving issue of shares for consideration other than cash. Okay, so some of the key requirements: preferential allotment of shares or further issue of shares, issue of sweat equity, valuation of consideration for transactions involving non-cash transactions, valuation for corporate restructuring or compromise, valuation for merger and amalgamation, valuation for purchase of minority shareholdings, for submission of report by a company liquidator, for audit committee reference or slump sale, for proposal to wind up voluntarily, and for valuing interest of any dissenting member of the transferor company. These are some of the instances where valuation reports are popularly required to be issued by a registered valuer under Companies Act 2013. With this, we can move on to certain provisions and regulations of Foreign Exchange Management Act. As per RBI guidelines, the fair value of equity instruments of an Indian company in case of allotment or transfer to or from non-resident, that must be carried out in accordance with any internationally accepted valuation methodologies. Now for listed companies, the listed companies valuation and pricing methods, they are driven by Sebi guidelines. But for unlisted companies, the transfer or allotment of equity shares or any other capital instruments, it has to be done at fair value, and this should be valued as per any internationally accepted pricing methodology by a chartered accountant or a merchant banker or a cost and work cost CWA, ICWA, as may be specified under various regulations. So these are some of the instances where valuation is required under FEMA: acquisition through rights issue or bonus issue, issue of shares by an Indian company to a person resident outside India, transfer of shares from a person resident in India to a person resident outside India, transfer of shares by a person resident outside India to a person in India, swap of equity shares, fresh issue of Indian company shares by subscription to memorandum of association to a person resident outside India, issue of warrants, and outbound investments. These are some of the important requirements that I have captured for valuation required under FEMA. So acquisition through rights issue or bonus issue. In case of listed Indian company, the rights issued to person resident outside India, it can be determined, it shall be determined at a price determined by the company. But in case of an unlisted Indian company, the rights issued to persons resident outside India will not be at a price less than the price offered to a person resident outside India. This is just a pricing guideline. Now, in case an Indian company issues shares to a person resident outside India, the price shall not be less than, okay, it has to be minimum. It cannot, it cannot be less than the valuation of such equity instrument done as per an internationally accepted pricing methodology on an arm's length basis, which is duly certified by a chartered accountant or a merchant banker or a practicing cost accountant in case of an unlisted Indian company. Okay, and it has to be an unlisted company. And once it is, for an unlisted companies, these guidelines apply. Now, if there's a transfer of shares, okay, not an issuance, but a transfer from a person resident in India to a person resident outside India, then the price should not be less than the valuation of such equity instruments done as per any internationally accepted pricing methodology on an arm's length basis, again duly certified by a merchant banker or a chartered accountant or a practicing cost accountant in case of an unlisted Indian company. These are less than. Now the reverse, where the transfer of shares by a person resident outside India to a person resident in India is happening. So in that case, the price should not be more than, okay, the price cannot be more than the valuation of such equity instruments done as per any internationally accepted pricing method on an arm's length basis, duly certified by a chartered accountant or a merchant banker or a practicing cost accountant in case of an unlisted Indian company. Okay, so I have put specific provisions where the valuation method and the valuation professional references are mentioned for our future references. Then there are swap of equity instruments. So in case of a swap, in any scenario, irrespective of the direction of the transaction, the valuation has to be undertaken by a merchant banker in India or an investment banker outside India who is registered with an appropriate regulatory authority in the host country. Okay, so in case of swap of equity instruments, merchant banker registered with the Sebi, with the Securities and Exchange Board of India, or an investment banker outside India who is registered with an appropriate regulatory authority in that country, in the host country, can undertake this kind of a valuation. The regulation also defines equity instrument. It means equity shares, convertible debentures, preference shares, and share warrants issued by an Indian company. Okay. Then there is a fresh issue of Indian company shares by subscription to memorandum of association to a person resident outside India. So FEMA guidelines say that where shares in an Indian company, they are issued to a person resident outside India in compliance with provisions of the Companies Act 2013 by way of subscription to Memorandum of Association, then this investment will be made at face value. And of course, it will be subject to entry rules and sectoral caps. So the interpretation is that no specific valuation report is required in this particular scenario. In case of share warrants, the pricing and the conversion formula will be determined upfront. So say there are convertible equity instruments, the price or the conversion formula of the instrument has to be determined upfront at the time of issue of the instrument. The price at the time of conversion should not in any case be lower than the fair value worked out at the time of issuance of such instruments. So again, to determine this price or conversion formula, a valuation report will be required. So the price or conversion formula has to be determined at the time of issue, and the price at the time of conversion cannot be lower. It cannot be lower than the fair value worked at the time of the issue. And because you have to upfront mention the conversion ratio or the formula, you need a valuation report to substantiate that finding. Outbound investments, overseas direct investment transactions. So where the investment in any foreign company is more than $5 million US dollars, the valuation of the shares of that company can be made by a merchant banker or an investment banker or merchant banker registered outside India with an appropriate regulatory authority in the host country. And in all other cases where the threshold is not required, a chartered accountant or a certified public accountant can prepare and certify such a report. Okay, so in case of a partial or full acquisition of an existing foreign company where the investment is more than 5 million US dollars, valuation of the shares of the company shall be made by a category 1 merchant banker registered with Sebi or an investment banker or merchant banker outside India registered with the appropriate regulatory authority in the host country. And in all other cases by a chartered accountant or a CPA. And in cases of investment by way of swap of shares, like we discussed, irrespective of the amount, valuation of shares will have to be made by a category 1 merchant banker or an investment banker outside India. Okay. So we'll just go through the valuation purpose, valuation, which kind of professional can undertake that and what approach can you follow. So if there's an issue of shares by an unlisted Indian company to a person resident outside India, then a chartered accountant or a merchant banker or a practicing cost accountant can undertake that valuation as per any internationally accepted pricing methodology. If there is a transfer of shares from a person resident in India to a person resident outside India by an unlisted company, again, a chartered accountant, a merchant banker, or a practicing cost accountant can undertake that valuation using any internationally accepted pricing method. If there's a transfer of shares by a person resident outside India to a person resident in India, then a chartered accountant or a merchant banker or a practicing cost accountant can undertake that valuation using any internationally accepted pricing method. In case of a swap of equity instruments, a merchant banker or an investment banker, registered in the host country, there is no specific methodology prescribed, but practically any internationally accepted pricing method has to be used. Outbound investments of more than 5 million US dollars, a merchant banker or an investment banker outside India can undertake the valuation. Again, there is no prescription of a method, but fair value as per any internationally accepted method. Outbound investments of less than $5 million, a chartered accountant or a CPA can undertake that valuation. Okay, so to conclude the pricing guidelines as per FEMA, at whatever time the Indian company issues a capital instrument, the price should not be less than the price in accordance with relevant Sebi guidelines for listed company, or when it's going through a delisting process. For an unlisted company, the fair value has to be determined as per an internationally pricing method that we've just discovered. For a convertible capital instrument, the price of conversion should not be less than the fair value at the time of issuance of capital instruments. For swap capital instruments, the valuation will be made by a merchant banker or an investment banker outside of the country. If an Indian company is issuing shares to a person resident outside India through subscription of MOA, then the value has to be at face value subject to entry rules. For pricing in case of capital, convertible capital instruments in case of share warrants, it cannot be lower than the fair market value determined at the time of issuance of such warrants. And Indian entities which have received indirect foreign investment, they have to comply with the pricing guidelines, which will be applicable to any kind of foreign investment. So all in all, this is the summary of the major valuations that we can undertake or are required to undertake under FEMA guidelines. Let us discuss some key provisions and sections of Income Tax Act 1961 and guiding rules. So predominantly valuation under income tax is generally implicated in case of an issue of shares or a transfer of shares other than quoted shares without consideration, or for consideration which is less than fair market value, in case of a receipt of property without consideration, or for consideration which is less than the FMV of the property, for an indirect transfer of shares, for perquisite valuation, or for issue of shares, for transfer of intangibles, etc. under transfer pricing. So some of the valuation references: if there is an issue of shares from an issuer perspective, valuation will be required under section 56 to 7B of the Income Tax Act 1961 and Rule 11 UA 2 of Income Tax Rules 1962. For a transfer of shares from subscribers perspective, valuation of shares and securities under section 56 to 10 of the Income Tax Act 1961 and Rule 11 UA 1C of Income Tax Rules 1962. Valuation is also required under slump sale of business, which is guided by section 50B. Then there are valuations required for transfer pricing provisions under section 92. Income deemed to accrue or arise in India in case of indirect transfer of shares. So valuation of shares and securities under section 9 of the Income Tax Act 1961 and which is guided by Rule 11 UB and 11 UC of Income Tax Rules 1962. There could be valuation requirements of perquisites in respect of ESOPs or sweat equity shares, which is covered under section 17 and Rule 3 of Income Tax Rules 1962. Let us briefly see what these sections, portray. So as per section 56 to subsection 2 and clause 7B, if a private company receives in any previous year from any resident consideration for issue of shares, which is higher than the face value of such shares, then the difference between the aggregate consideration received for such shares and the fair market value of the shares will be charged to income tax under income from other sources. So if there's a company issuing shares at a premium, then the amount that is received in excess of the fair value of such shares is considered to be taxable in the hands of the issuer company. Now, tax rules have prescribed determination of FMV for issuance of such shares, and it is prescribed to be higher of the FMV which you compute under Rule 11 UA 2, or as may be substantiated by the company to the satisfaction of the assessing officer. Okay, but since the method is based on book value of the assets, it may not in all cases. So this is essentially Rule 11 UA 2. Now, part 1 is based on book value of the assets. So it may, in all cases, it may not correspond to the aggregate consideration. And that's why the company may have to substantiate the value to the assessing officer, which is an option given to the company. So in most cases, I have seen that companies follow the DCF method based valuation, which is undertaken by a merchant banker. Now, consideration can be in cash or in kind. Now, if the consideration is in kind, then the value of the things obtained in exchange could be considered as the value. The clause contemplates that, if there is the receipt of consideration is for issue of shares. Okay. So if there is no consideration for the issue of shares, this clause is not applicable. Any person who is satisfying the test of residence or he is a resident is covered under this section. So therefore, any person who is a non-resident within the meaning of the definition that person is not covered or is not required to undertake any valuation for complying with this section. And so any consideration paid by a non-resident to a closely held company for the shares in it, even if the amount of premium exceeds the fair market value, the company is not liable to tax in that case. Okay. For this reason, the clause does not apply to bonus shares, as such shares are issued without charge or without any consideration. And no new funds are raised because with the issue of bonus shares, and thus this clause will not apply to bonus shares. So quickly, this under Rule 11 UA2 and Section 56 to 7B, value can be computed at the option of the assessee by using either A or B below. So A is a straightforward and not an adjusted, but a straightforward net worth formula. And B is FMV of shares as determined by merchant banker as per DCF method. And the companies can undertake valuation under both A and B, and but generally companies will use the DCF based method for reporting purposes. Okay. Valuation of shares and securities under section 56 to 10. Now this is applicable to recipient of shares and securities, and section 50CA is applicable to the seller of shares. As per this section, if a person is receiving any property other than immovable property without consideration, or for a consideration less than fair market value of such property by an amount exceeding 50,000 rupees, the difference between the fair market value of the property and the consideration paid shall be taxable in hands of recipient as income from other source. All right, so here it's any property other than immovable property. This is Rule 11 UA 1C, valuation of shares and securities, where the various guidelines are prescribed by the rule for valuation of shares, if they are quoted and if they are unquoted, both. Okay, so valuation for unlisted companies is to be computed using the adjusted book value method as above. And while 56 to 10 is applicable to the recipient of shares, section 50CA is applicable to the seller. The next provision is section 50B, which prescribes provisions for computation of capital gains in case of a slump sale. So the determination of the fair market value of capital assets, this is prescribed under Rule 11 UAE, and it suggests considering hire of FMV1 and FMV2. Now both FMV1 and FMV2 are explained in detail and certain references are also made to valuation of certain assets like jewelry, etc. by a registered valuer. But here the registered valuer is the valuer under wealth tax rules. And valuation of shares, they are suggested to be valued in the same way as under Rule 11 UA. So the understanding is that a CA or a merchant banker can definitely undertake valuation under this particular section reference. Okay, so computation of fair market value of capital assets for section 50B of Income Tax Act. You have FMV1. FMV1 is it mentions the same formula for as in Rule 11 UA. So we have book value of assets, then we have the price of jewelry and artistic work, fair market value of shares and securities, value adopted for stamp duty in respect of immovable property, and subtracted by book value of liabilities as appearing in the books of accounts after the various adjustments. That is FMV1. FMV2 is comprises of a formula E plus F plus G plus H, where E is value of money consideration as a result of transfer. F is the fair market value of the non-monetary consideration. G is the transfer of property other than immovable property, which has to be obtained by the report has to be obtained by a registered valuer. However, registered valuer will have the meaning assigned to it in section 34 AB of Wealth Tax Act, read with the wealth tax rules. So higher of the two is considered to be the fair value for slump sale basis. Valuation is also required for transfer pricing, and it can be using any of the methods. So transfer pricing, any income arising from an international transaction shall be computed having regard to the arm's length price. And there are various methodologies which are prescribed: the comparable cup method, resale price method, cost plus method, profit split, and transactional net margin method, or any method as may be prescribed by the board. So no specific mention as to who can undertake the valuation is referenced, but in practice, a CA or a merchant banker can undertake valuations under transfer pricing norms. Another relevant section is Section 9. It's a deeming provision under the Income Tax Act. It specifies a certain income that is deemed or supposed to be accrued or arise in India in certain circumstances. The income of non-residents that cannot be taxed unless it falls in provisions of Section 9 of the Income Tax Act. As per Section 9, subsection 1, certain incomes are deemed to have arisen in India for taxability, and it is said to have been incurred in India even if they accrue or arise outside India. Maybe because there is an asset which is located in India, or there is a business connection in India, or through any other source of income in India. The rules of valuation which are prescribed in Section 11UB and 11UC of the rules, and the rules prescribe that where the asset is a share of an Indian company, is not listed on a recognized stock exchange on the specified date, the fair market value of the share shall be its fair market value on such date as determined by a merchant banker or an accountant in accordance with any internationally accepted valuation methodology for valuation of shares on arm's length basis, as increased by the liability, if any, considered in such determination. So that is where valuation is required under Section 9. This is a snapshot of Rule 11 UC, where it says how you can determine the income attributable to assets in India. Next, we may require valuation under Section 17 and the guidance of Rule 3, which states that in case where on the date of exercising of the option, the share in the company is not listed on a recognized stock exchange, then the fair market value shall be the value of the share in the company as determined by a merchant banker on a specified date. Now, this particular valuation can be undertaken by a merchant banker only. So for listed companies, the perquisite value is the quoted price minus the exercise price. And for an unlisted company, the perquisite value is the fair market value determined by merchant banker minus the exercise price. So these are the guiding sections for Section 9. This is a summary of Section 56 to 10 under the various clauses, where the shares are quoted or where they are not quoted. That is just mentioned, and what kind of value you can take for fair market value purposes. But the essence is, for all the transfers and issuance of shares, we do need valuation reports. So yeah, slump sale, there is no mention of valuation professional. In general parlance, a chartered accountant or a merchant banker can undertake. The valuation approaches as prescribed under Rule 11 UAE. Transfer pricing, again, no specific mention. A CA or a merchant banker can undertake as per any internationally accepted method or as prescribed under Section 92C. Valuation of common stock, for perquisite valuation for unlisted entities, a merchant banker can undertake as per an internationally accepted pricing method. Income deemed to accrue or arise in India in case of indirect transfer of shares, a chartered accountant or a merchant banker can undertake as prescribed under Rule 11 UB and 11 UC. These are some of the Sebi regulations where valuation is required. Again, in both cases, there is valuation for open offer, there is valuation for preferential allotment under ICDR guidelines, there is valuation required for delisting under delisting guidelines. Valuation is required for scheme of arrangement involving listed companies in India. Then there is valuation of infrastructure investment trusts or InvITs, and real estate investment trust or REITs. We'll just see what kind of, who can undertake the valuations under the various, Sebi regulations. So the first one is Sebi Substantial Acquisition of Shares and Takeovers Regulation 2011. Now, in both cases, if the shares are infrequently traded would mean the number of shares traded in the last 12 calendar months are less than 10% of the total number of shares of that class, or is incapable of being determined. So say due to suspended trading or insufficient precedent of share prices. Now, under any of the options prescribed, valuation has to be undertaken using valuation parameters, including book value, comparable trading multiples, such as and such other parameters which are customary for valuation of shares of such companies. Who can undertake this valuation? Independent merchant banker, other than the manager to the open offer, or an independent chartered accountant in practice having a minimum experience of 10 years can undertake the valuation. These are all regulations pertaining to pricing of shares in under SAST guidelines. So in case of indirect acquisition of shares or voting rights, it can be the highest negotiated price or the volume weighted average price, the highest price paid or payable for any acquisition, the highest price paid or payable for acquisition, again subject to certain terms, and the volume weighted average market price of shares for a period of 60 trading days. Okay, now in the event the offer price is incapable of being determined under any of the parameters, then it has to be done using valuation parameters, including book value, comparable trading multiples, and such other parameters which are customary for valuation of shares. And it can be undertaken by an independent merchant banker or a chartered accountant with minimum experience of 10 years. It is applicable to infrequently traded shares. Pricing guidelines for preferential allotment of shares under Sebi, issue of capital and disclosure requirements, amendments, regulations 2022. So there has been a recent amendment in Jan 2022 with respect to ICDR guidelines. So the Sebi ICDR regulations, they lay down guidelines for share issuances, including public and rights issue. Now there have been amendments, and the amendments were mainly pertaining to the pricing norms and valuation requirements. The references to the 26 weeks and 2 weeks, it has been approved to be replaced with 90 trading days and 10 trading days respectively. Another regulation 166A was also inserted, wherein if there's a preferential allotment and it causes a change in control, or it results in allotment of securities made to a single allottee or allottees in concert of more than 5% of post-issue diluted share capital, then the pricing has to be determined by a registered independent valuer, in addition to the pricing methodology under regulations of 164. All right, so we'll just see what changes have been made. Wherever we've striked off 26 weeks, for example, that was the earlier provision. That has been replaced by 90 trading days. So in terms of regulation 164, if the equity shares of the issuer have been listed on a recognized stock exchange for a period of 90 trading days or more as on the relevant date, then the price of the equity shares to be allotted shall not be less than higher of the following: 90 trading days VWAP, okay, or 10 trading days VWAP, provided that if the articles of association of the issuer provide for a method of determination which results in a floor price higher than the determined method that determined under these regulations, then the same shall be considered as the floor price for equity shares to be allotted pursuant to the preferential issue. Okay, so if you're using other methods and the articles are also suggesting so, then you have to use other methods of valuation as well. But now, in practical parlance, I think all valuers, even if it's for ICDR, we are just not going by the formula, and we are using all fair valuation methodologies and then applying weightages, appropriate weightages to arrive at a particular value. Any thoughts on this? Please feel free to put on the chat box. Okay, this is the pricing guideline. It cannot be higher than the following. So in 26 and 2 weeks have been replaced with 90 trading days and 10 trading days. these are certain other changes. So wherever we've knocked off, everywhere 26 weeks is now 90 trading days. 19 provisions or guidances of section 1956 have gone away completely. And 2 weeks are replaced by 10 trading days. This is pricing in preferential issue of shares or of companies having stressed assets. Similar changes are here as well. Pricing of infrequently traded shares. So where the shares of an issuer are not frequently traded, then the price determined by the issuer shall take into account the valuation parameters, including book value, comparable trading multiples, and such other parameters as are customary for valuation of shares of such companies, provided that the issuer shall submit a certificate stating that the issuer is in compliance of this regulation obtained from an independent registered valuer. Here, the independent registered valuer refers to a person who is registered under Section 47 of the Companies Act. Okay, so the registered valuer can undertake this valuation. This is Regulation 166 that we were referring to, which requires valuation in case of change in control of the issuer pursuant to allotment of such shares. In India, I think there are a very large number of entities. They do get listed on stock exchanges, but then there is no public interest. And in fact, they start to become non-compliant. And eventually, there is no operation or anything. But because of the cumbersome process of delisting, the companies choose to just remain listed. So I think the delisting of equity share regulations 2021, they have probably made a delisting process much smoother. So this regulation essentially says that where the equity shares of a company, they are delisted by a recognized stock exchange under this chapter, then the recognized stock exchange will appoint an independent valuer who can determine the fair value of the shares of the delisted company. Again, valuer here would refer to the registered valuer under section 247 of the Companies Act. Okay. So where the equity shares of a company are delisted by a recognized stock exchange, the recognized stock exchange will appoint an independent valuer who can determine the fair value of the delisted equity shares. Voluntary delisting is not subject to any specific valuation requirements, and it is based on mechanics of a discovered price through the floor price and the book building process. A very important this circular that is on valuation of listed entities. So listed entities, they are required to submit a valuation report from a registered valuer. Now, for the purpose of this clause, the registered valuer is a person having such qualification and is registered under section 247 of the Companies Act. However, valuation report is not required in cases where there is no change in the shareholding pattern of the listed entity or resultant company. Okay, so if there is no change in a shareholding pattern of the resultant company, then there is no valuation report required. Further, the circular also guides us that in case a listed company demerges a unit and it makes it a separate company. Now, if the shareholding of of entity B or the separate company is comprised only of shareholders of entity A, again, it is a case of no change in shareholding pattern, and so no specific valuation report is required in that case also. A third case is that every shareholder in entity B holds equity shares in the same proportion as held in entity A before the demerger. In that case, also there is no requirement of valuation. Another case could be in case of a wholly owned subsidiary of a listed entity, and that is merged with the parent listed entity, where the shareholders and the shareholding pattern of the entity remains the same. Again, this is a case of a no change in shareholding pattern. Okay, in all these cases, the circular does not mandate any valuation. This is an annexure which has to be attached to all valuation reports by registered valuers, which essentially deals with the the valuation approaches and methods that you all have undertaken. And finally, you get the relative value and the exchange ratio, which is rounded off. Okay, it comes under annexure 5 to this circular. Then we have InvITs and REITs. They are very much like I think mutual funds, and they are like investment vehicles for retail investors. So what it does is they will make direct investments of very small amounts of money from some institutional investors in the infrastructure sector or the real estate sector to earn returns. As per the markets, as per the master circular, where the units of the InvITs and REITs are not frequently traded, the price determined by the InvIT or the REIT shall take into account the NAV of the InvIT based on full valuation of all existing InvIT and REIT assets, and which has to take care of the book value, the comparable trading multiples, and such other parameters as are customary for valuation of the units of the said InvITs and REITs respectively. Okay, these approaches and the methods are common throughout Sebi guidelines. Okay, so here there is an investment manager, and he is under the responsibility to compute and declare the NAV of the InvIT based on the valuation done by the valuer. Valuer has certain constraints here. So the valuer shall not be an associate or investment manager or trustee. He shall not have less than 5 years of experience in valuation of infrastructure assets. And full valuation includes a detailed valuation of all assets of the InvIT by the valuer, including physical inspection of every infrastructure project by the valuer. So there are certain do's and don'ts for the valuer in chapter 5 of this particular regulation on InvITs. Also, their appointment is subject to certain conditions. So a full valuation has to be conducted not less than once in every financial year, and no valuer can undertake valuation of the same project for more than 4 years consecutively. Okay. Similar terms are associated for real estate investment trust also. The valuer should have a minimum experience of 5 years for valuation of real estate assets, and all real estate or the physical inspection of every property is required by the valuer. There's a schedule for mandatory minimum disclosures which are pertaining to the valuer and the valuation. Once in a year, the full valuation has to be conducted, and a half-yearly valuation of REIT assets can be conducted by the valuer for the semi-annual year ending on 30th September. No valuer can undertake valuation for the same property for more than 4 years consecutively. So these are some terms for the valuer. Okay. So the valuation purpose, if it's offer price for open offer under SAST regulations for infrequently traded shares or the price is not determinable, an independent merchant banker other than the manager to the open offer or an independent chartered accountant in practice having a minimum experience of 10 years. Valuation has to be undertaken using valuation parameters, including book value, comparable trading multiples, and such other parameters. Preferential allotment of shares. A registered valuer has to do it. And again, it's ICDR guidelines, but these are for infrequently traded shares. You have to determine using valuation parameters, including book value, comparable trading multiples, and such other parameters. Pricing guidelines under Sebi, delisting of equity shares. A registered valuer has to do it. And similar method, you use the book value, other multiples, and other parameters. Scheme of arrangement, other than cases where valuation report is not required. Again, a registered valuer is required to undertake such valuations, and various methods can be adopted and appropriated weightages can be applied. Valuation of infrastructure investment trusts or REITs, a registered valuer with minimum experience of 5 years in valuation of infrastructure assets or real estate. And again, methods will be similar: book value, comparable trading multiples. A detailed valuation of all assets of the InvITs and the REIT, including physical inspection, has to be conducted by the valuer in this case. We'll move on to the Insolvency and Bankruptcy Code 2016, which also requires valuations by a registered valuer. So the guiding sections will be section 59, where there is voluntary liquidation of corporate persons, section 46, section 27, read with chapter 35, Then Regulation 35 for liquidation process, and Regulation 26 for fast track insolvency resolution process for corporate persons. So for voluntary liquidation of corporate persons, a report of the valuation of the assets of the company is required, and that can be prepared by a registered valuer. This is voluntary liquidation of corporate persons, and this is under the IBBI Voluntary Liquidation Process Regulations 2017. Relevant period for avoidable transactions. So Section 46, it mentions that the adjudicating authority may require an independent expert to assess evidence relating to the value of the transactions mentioned in this section. Okay, so in an application for avoiding a transaction at undervalue, the liquidator or the resolution professional shall demonstrate that such transaction was made with any person within the period of 1 year, and this was made with a related party within a period of 2 years. And to substantiate this, a valuation report by an independent expert can be required. Conduct of corporate insolvency resolution process. So Regulation 27 of IBBI Insolvency Resolution Process for Corporate Persons. In this case, the insolvency resolution professional has to appoint 2 registered valuers to determine the fair value and the liquidation value of the corporate debtor. And of course, then there are certain guidelines as to who cannot be appointed here in this case. A relative or a related party of the corporate debtor, or the auditor, or a partner or director. So this is just to maintain independence. Regulation 27 on insolvency resolution process for corporate persons. So here again, fair value and liquidation value has to be determined, and 2 registered valuers have to be appointed under Regulation 27, and they have to submit to the resolution professional an estimate of the fair value and of the liquidation value computed in accordance with internationally accepted valuation standards, after, of course, physical verification of the inventory and fixed assets of the debtor. And for every class of asset, a registered valuer is appointed for every class of asset, and fair value and liquidation value both have to be determined. Okay, now if in the opinion of the resolution professional, the 2 estimates of value, they are very different, then another registered valuer can be appointed who will submit an estimate of the value computed in the same manner. And the average of the 2 closest estimates of a value will be considered as the fair value or the liquidation value. Fast track insolvency resolution process for corporate persons. So the resolution professional will, within 7 days of his appointment, he has to appoint 1 registered valuer to determine the fair value and the liquidation value of the corporate debtor. To maintain independence, the registered valuer cannot be a relative of the RP or a related party of the corporate debtor or the auditor of the corporate debtor for a certain timeline, and the partner or director of the IP entity. Okay, this just mentions that the registered valuer will submit to the resolution professional an estimate of the fair value and of the liquidation value computed in accordance with internationally accepted valuation standards after physical verification of the inventory and fixed assets of the corporate debtor. Okay, so like I mentioned that, a single transaction could involve various regulatory compliances. So we'll just discuss, and if you all can probably pitch in. So if there is an issue of shares by an unlisted company issue of shares by an unlisted company to a resident, then you need valuation by a registered valuer using ICAI valuation standards or internationally accepted valuation methods, and FEMA will not be applicable. Valuation under 56 to 7B will be required, and it will be higher of the net worth formula under Rule 11 UA Clause 2 or FMV as determined by merchant banker using the discounted cash flow method. Again, Sebi is not applicable because it's an unlisted company. if there is issue of shares by a listed company to a resident, is Companies Act provision applicable? So no valuation is required under Companies Act. Since only residents are involved, even FEMA is not required. Yes, Sebi valuation will be required as per ICDR guidelines. If it's infrequently traded, then valuation has to be done by a registered valuer. However, listed companies with frequently traded shares may obtain a valuation report from a registered valuer. Issue of shares by an unlisted company to a non-resident. Companies Act, you need a valuation report by a registered valuer. For FEMA, you will need valuation using internationally accepted methods. Income tax is not applicable for issue, but yes, 56 to 10 could be triggered for the recipient, and Sebi is not applicable. Issue of shares by a listed company to a non-resident. Companies Act is not required in this case. Even FEMA valuation is not required. Income Tax Act is also not required, but again 56 to 10 could be triggered for the recipient. For Sebi, valuation will be required. Transfer of shares by shareholders of an unlisted company to a resident. For transfer, no Companies Act implication, no FEMA implication because no non-resident is involved. For transfer, income tax will be mandated under section 56 to 10. Transfer of shares by shareholders of a listed company to a resident. Companies Act, FEMA, it's not applicable. Income tax 56 to 10 will be required. Transfer of shares by shareholders of an unlisted company to a non-resident. Again, Companies Act, it is not required because it's a transfer. FEMA, because there is a non-resident involved, valuation has to be undertaken. It's a transfer, so valuation will be required under section 56 to 10. And Sebi, there is no implication. There is a transfer of share by shareholders of a listed company to a non-resident. No valuation will be required under Companies Act. It's a listed company. Only 56 to 10 could be indicated, but even then it's not mandatory to be obtained. Buyback of shares, there is no mandatory valuation requirement. FEMA, valuation using internationally accepted method if NRI shareholders are involved. Income Tax Act, again, it is not applicable, but I've seen some clients asking for, mentioning income tax purpose also in case of a buyback. Sebi, no mandatory valuation requirement, even if the company is listed. Rights issue of shares, again, no mandatory valuation. Valuation can be undertaken if issue is made to a non-resident shareholder under FEMA regulations. Income tax, it's not applicable. And Sebi also no mandatory valuation requirement, even if the company is listed. And for capital reduction, Companies Act does not mandate any valuation. FEMA, it's not income tax. So there is no mandatory requirement under any of the provisions. Issue of bonus shares, no mandatory valuation requirement. No mandatory valuation requirement under FEMA also. There is no consideration. Consideration is absent, so no income tax implication. And Sebi perspective also, nothing is required. For ESOPs, valuation is required under Ind AS for sure. Income Tax Act, if there is a perquisite valuation required, then yes, you have to undertake a valuation under income tax. Issue of sweat equity, valuation is required for both equity and IPR. FEMA is required as per internationally accepted methods. Income tax will be required for perquisite tax calculation. And Sebi, it is the minimum price is defined based on the average high and low prices. So yeah, this is it. If we can discuss questions or any concerns if you have now. How do I stop sharing the screen? So Sagar has a question. If a domestic company is issuing shares to resident or non-resident at face value and no premium, whether valuation report is required under Companies Act or under FEMA. So Companies Act definitely is required. It's a if a non-resident is involved, even then FEMA is also required. So yeah, for both Companies Act and FEMA, it will be required, irrespective of what price it's getting issued at. Any other questions? Asim, Bhakti, anything from y'all? Anybody wants to share any thoughts, their views, their experiences?
Yeah, hi Rashmi, this is Sagar here.
Yeah. Hi,
Audible?
Sagar. Yes, you are.
So my question is that under the Companies Act, even if we are issuing the shares at a face value also, then also we require the valuation report. And the
Yes,
Companies
yes,
Act
we do.
has not really defined any method. So we can use the book value method also, right?
So Companies Act is saying you use value as per your, registered value organization or as per internationally accepted methods. Since ICAI has its own valuation standards, we are mandatorily, or we should be using ICAI valuation standards 2018. And if we are diverting, then in any case, we are aligned with the internationally accepted methods also. So it does mention what is there. Now, book value, as such, I have not seen it coming under any internationally accepted method. But yes, NAV or book value method is still being used for Companies Act compliance. So we can use that.
Just to add over there, just to add over there, I think so. If you are using net assets value method to arrive at the value of the shares, you need to have justification as to why the other methods are not being adopted. It's not just that you take NAV and just use it. You need to have a rationale and you need to explain in the report why you're not using other methods or why it is not appropriate.
And
also,
whatever value we, please.
And also, one needs to be careful that now the Companies Act no longer, I mean, the valuation standard no longer prescribes NAV as a method. It's replacement cost. So you need to be clear, what method you are applying. So Rashmi, what is the consensus on that part? Whether for accounting Ind AS related valuations, whether we require a registered valuer or no, or should we go by what is the requirement of the auditor?
So generally, we go by the requirement of the auditor, and I have seen them taking both. They are generally indifferent. You said you can sign as a CA or a registered valuer. We are okay with both.
So where let's say you are required to sign as an RV on an Ind AS report, so which section do you refer to as to what is the section under which the requirement is there? You refer to the accounting standard section, or you refer to that section 177, which is the sort of a residual section?
No. If say for example, I'm doing for ESOP, then I refer to Ind AS 102. So it depends on if I'm doing for impairment, then it's a different section. For PPA, we say it's for business combination. So
no. So that is the Ind AS reference. But what under Companies Act, if you have to give a quote a section, which section would you quote? This would be under Ind AS, 102, 103, whatever. But if we are giving an RV report, because currently the mandate is only for companies at related valuations, right?
Yeah, but under Companies Act, what valuation under Companies Act?
So I am saying no. So that's what. So let's say you are appointed independently to value let's say carry out a PPA or an ESOP valuation. Now, if the auditor says that I require this valuation on an RV's letterhead, so would you quote any Companies Act section or just the Ind AS relevant Ind AS?
So I quote the relevant Ind AS, and of course we also mention it's for accounting and financial reporting. So,
All
but
right.
yeah, the relevant Indian accounting standard is specified in the report.
All right.
So Hitesh is asking that FEMA requires international standard to be followed for valuation. Will this result in carrying out any different valuation under FEMA when valuation for the same transaction may be undertaken under the other act? Other than income tax, where there is a prescription of book value, almost all the statutes are requiring internationally accepted valuation methods. So the result or the approach is generally the same for one single transaction. That is my experience. If anybody has different views, they can, please feel free to chip in.
No, we also have the same view, only a minor correction there in Hitesh's question that, FEMA does not require any international standard. It only says internationally accepted
Internationally
methodology.
accepted valuation. Yeah.
Yeah.
Yeah, I think that is what he meant. So they are internationally accepted valuation methodologies.
So even if the valuation is required under Companies Act and we are following the valuation standards issued by the ICAI valuation, basically following the Institute of Chartered Accountants of India's valuation standards, the methodologies are still internationally accepted valuation methodologies. The methodologies are no different than the internationally accepted valuation methodology. So it does not matter whether you do it under Companies Act or whether you do it under FEMA. The methodology is the same.
Okay. Anand is asking if a listed company issuing ESOPs. So if a listed company is issuing ESOPs, who can do the valuation and what method is to be followed? Any thoughts? Anyone?
Sorry, what was the question, Rashmi?
If a listed company is issuing ESOPs, who can do valuation and what method is to be followed?
No, so if I am presuming that if a listed company is issuing ESOPs, then the requirement is to be done as per the audit requirement as of the grant date, right? In which case it would follow the 102 methodology, right? There is no separate section which says that at the time of issuing ESOP, any equity valuation has to be done.
Personally, I have seen, so it may not be a listed company, but for unlisted companies, I have seen clients asking for valuation of shares to determine the grant price to issue ESOPs. So that is one valuation requirement for ESOPs that I have come across, other than the valuation as of grant date that you are mentioning about.
So are you saying the requirement is to determine the exercise price?
Yes. You value equity shares to determine the value, to determine the exercise price for granting ESOPs.
But then there is no regulatory requirement to determine the exercise price, right? Let's say the market price is 100 rupees, then the management has a free hand in sort of determining as to at what rate it would like to issue it. What rate would it want to keep the exercise price, right?
Right. There is no regulatory requirement. So that is a question.
I think so it will be more from the accounting standard perspective, because in the accounting standards you need to create, take that notional difference between the fair value and the exercise price or whatever, and take that into account every year. I think so that could be the reason why this would be required. And in certain cases, most of the companies issue ESOPs even at the price at which is determined by the valuer.
Yeah.
To say that this is the exercise price.
Right.
Yeah,
so
that's what I was referring to. That valuation is definitely, I've seen practically clients obtaining valuations to determine the exercise price.
Yeah. Otherwise, they will have a hit in their accounts every year if the exercise price is lower.
Rashmi,
Yes.
see, anyways, under the ESOP, if the fair value is, let's say, for example, the 100 rupees, then obviously the exercise price would be far lower than the fair value price, right? Then only they would be really getting the benefit or the incentive, which the ultimate intention of the ESOP, right? So how would we be arrive at the value of the exercise price under the valuation?
No. We determine the value of the shares, and then it's management's discretion. They probably want a benchmark to, determine the exercise price and see the moneyness of the option, and then grant it accordingly. For our role is to determine the fair value of the share. Depending on the spot price, they will determine the exercise price.
So basically, you will arrive at the fair value of the share price of the company, and then the management would decide that, okay, how much they really want to compensate or incentivize the employees, right? But in that particular, I have a doubt that how, so basically, as on which particular valuation date you would arrive at the valuation, the fair value of the share. For example, if you are issuing the, if you're basically drafting the ESOP scheme for the employees, and then ultimately after 3 years they are going to have the shares on their account, okay, through the granting, vesting and exercise, okay. So now on which particular date you would arrive at the fair value of the shares, on the today or after the 3 years when they are going to have the shares?
No. So when we do it, it will always be as of the time when they are intending to grant. So that may not that may not cover the share price in the future. That is obviously subject to contingencies. But for this particular scope, it's always as of the date of the grant, or as and when the management wants to issue ESOPs.
So Anand here, actually, I have seen that merchant banker is opting for Black-Scholes model for valuing this exercise price of, in terms of ESOP valuation. So the question is whether a registered valuer or CEO can value this, and can we opt for any other method? So
No. Black-Scholes model is used for what here? I mean, you said for
calculating fair value. Yeah.
Fair value of the option, you can use any option pricing model. No? That depends on the type of the option, the tenure of the option. So you can use option pricing models. Generally, Black-Scholes and binomial is what are used to determine the fair value.
Yeah, out of both, Black-Scholes is I've seen in ESOP thing. So the question was whether registered valuer can value this. Like, can we certify and give?
Practically, even I've seen merchant bankers doing that, but I think chartered accountants can do it. There is no specification of a registered valuer anywhere, unless other members here have witnessed something.
No, so there are two things, Rashmi. One is obviously, there is a distinction to be made between between share valuation and the option valuation. As what you mentioned.
He's referring to option valuation.
Yeah.
He's referring to option.
Right. And as far as the merchant banker involvement is concerned, merchant banker is mandatory required to be carrying out the valuation only under when they are doing that perquisite tax valuation. Until there is no specific. Yeah. So for accounting purpose, even a registered valuer is free to do option valuation methodologies or any other method.
Yeah. So it's only under FMV for valuing that capital gains under perquisites. Only then then it is mandatory that you take it from a merchant banker. Otherwise, practically, I have seen CA or MB or a RV. Anybody can undertake valuation of options for other reasons.
Okay.
Okay. Any other questions? Anybody? Any discussion pointers? So, Asim Bhakti, should we wind up the session if there are no further questions?
Yeah.
Yeah. I think we can. Yes.
Okay. Okay. Thank you, everyone. Then we will plan our next session and we will inform on the group regarding the same. Yeah. If there are any
Thank you.
sessions that, if there are any topics that you particularly as members want to cover or want us to cover, please put that in the group so that we can try and get those sessions on board in the coming months.
Yeah, in Rashmi, in the chat box, there is a request to share the presentation. So maybe that can be separately done.
Yeah, that I will. That I will. Yeah. Okay. Okay,
right.
sure. Thanks, everyone. Yeah. Bye.
Thanks, Rashmi.